There has never been a greater time than now to invest in the Metro Detroit area, and there is no other investment firm better qualified than Platinum Real Estate Holdings. With 40 years experience and over 1,000 homes sold, let Platinum Real Estate Holdings assist you with the purchase of a city-certified home of the highest quality. Turnkey properties, screen renters, yielding instant cash flow. Well, what are you waiting for? Call or visit us online today. Welcome to the weekly recap for the week of August 1st. In today's recap, we'll talk about why high-end real estate buyers will shift investment from London to the United States. And lastly, we will look at the housing forecast for the second half of 2016. Hang on, this week's recap begins now. High-end real estate buyers will shift from London to the U.S. The UK Treasury estimates that home prices will fall about 10%, while Alliance Bernstein Holdings LP forecasts losses as much as 30%. The major reason is Brexit. Brexit has a myriad of impacts on the global economy. One of them was a huge hit on UK's financial sector. Almost every financial institution in the city took it. A few saw their valuation slide as much as 15 to 25%. Real estate firms and home builders were no exception. They lost 20 to 30% of their value in just 2 trading days. On a related note, major London real estate agent Foxtons issued a profit warning the day after the Brexit announcement, highlighting that revenues and adjusted earnings were going to be significantly lower than last year. The UK real estate market is set for tough times. Although single-family home prices in the UK rebounded after the 2008 financial crisis and prices continue to increase in the first half of 2016, many analysts believe that the UK real estate market is heading for an extended down cycle. High-end property sales in London had already weakened even before the vote due to notably higher real estate transaction taxes that kicked in 2015. Savills UK head of research Lucian Cook explains why he expects a slump. The prospect of an increase in mortgage interest rates and a reduction in wage growth is expected to create greater affordability pressures over the medium term, particularly in London. Leonard Steinberg, the president of major U.S. real estate brokerage Compass, projects a 5% annual decrease in UK real estate sales for at least the next 2 years. He expects London to see the biggest losses. London has, for the longest time now, been the global center of the economy. This is a stumbling block for them, Steinberg commented in a recent interview. He goes on to say anything in the United States will fare well with the European-centric audience. He continued, New York, Boston, Chicago, Miami, Los Angeles will always do very well with a foreign buyer. Central London has been a safe haven real estate market for the very wealthy investors. Foreign buyers bought around 75% of their newly built central London homes in 2013. Almost 45% of the buyers were from Singapore, Hong Kong, and China, and a significant number also from Russia and the Middle East. A cheaper pound may mitigate some of the selling pressure. Luxury real estate analysts, however, highlight that the very wealthy try to avoid uncertainty as much as possible. They prefer real estate investments with stable, long-term growth. Brexit certainly clouds the future of London as the financial capital of Europe. The Brexit boon to U.S. real estate is also not just limited to the luxury market. The political uncertainty surrounding the entire snafu has led to a global flight to safety that has put downward pressure on U.S. bond and mortgage rates. Next up, housing forecasts. What to expect in the second half of 2016. Where have all the houses gone? That's the question economists and, more importantly, would-be home buyers are asking themselves. Demand is healthy and home values are rising. Owning a home remains a better deal than renting one, and mortgage rates are near record lows, meaning borrowing money to buy is cheap. Nevertheless, inventory is scarce and falling. At a time when rising prices should be inducing inventory, exactly the opposite is happening, explains Ralph McLaughlin, chief economist at real estate data firm Trulia. That has been the biggest story in the last 6 months, and it will continue to be a story for the rest of the year. According to Zillow, also a data firm, in May, inventory of low and middle tier homes fell an average of 9.3%, compared to a year earlier. Top-tier inventory fell about 0.5%. Now that we're halfway through 2016, here's a glimpse of how the rest of the year is likely to play out. 4 dynamics to look at. Number 1, mortgage rates could reach all-time lows. Fitch Ratings expects U.S. mortgage rates to reach all-time lows following the United Kingdom's vote to leave the European Union. This is because Brexit pushed the Treasury rates that serve as a benchmark for mortgage rates to new lows. The 30-year fixed rate is currently about 3.6%. Number 2, new construction remains slow. In May, groundbreaking stood at an annual rate of 1.138 million, below the 1.5 million needed to get supply back in line with demand. Adding to the pain, most of the homes that have been built in recent years have been for the luxury consumer rather than lower-priced starter homes. The question is, will builders ever build homes millennials can buy? The answer is maybe. Price growth has slowed to about 4% at the top end of the market, but has risen 8% on the lower end. The median home price has risen to 5.4%. Economic theory suggests rising starter home prices should entice new construction in the segment, says McLaughlin. Number 3, homeowners aren't selling. People aren't moving as often, meaning fewer existing homes are coming onto the market. Prices have risen so much that potential sellers can't afford to buy the next level home in their current neighborhood. McLaughlin calls the phenomenon gridlock. And number 4, demand is still strong. Home values are currently appreciating at an annual rate of 5%, well above the historic average of around 3 to 3.5%. What does it mean for you? 4 more things to look at and consider. Number 1, have your checkbook ready. Right now, the typical home is selling in just 42 days. In markets like Denver, Portland, and Seattle, sales are happening in a week or less. That is the shortest time that the organization Redfin has seen since it began tracking in 2009. With no clear supply bump on the horizon, this trend is likely to continue. Number 2, be prepared to pay asking price. At 95.3% of asking price, the average sale-to-list percentage is also the highest Redfin has seen. In some markets, including around San Francisco and other West Coast cities, the sale-to-list percentage is over 100%. The faster the market, the more likely the buyer is to overpay. People who need to act quickly can't negotiate. Other things to watch. The Fed. The Federal Reserve isn't expected to hike short-term rates more than once this year, meaning monetary policy will have negligible sway on mortgage rates. However, if markets are caught off guard by a hike, there could be some ripple effect, but this is highly unlikely. And finally, number 4, the election. Brokers are noticing some hesitation to list or buy a home given the uncertainty surrounding the presidential election. At the same time, in a survey of housing economists, Zillow found that markets' forecasts would not be affected if someone like Hillary Clinton were elected. However, if someone more outside the mainstream like Donald Trump were to become president, now again at the time of the survey, Ted Cruz and Bernie Sanders were still eligible candidates, the economists' forecast would be negatively impacted. However, not to worry. A new person occupying the White House is not expected to have a major impact on the overall housing market, says McLaughlin. Well, that's this week's recap. Did you find this recap helpful? Let us know in the comments below. Thank you for listening and have a great day. This has been your weekly real estate investment news recap. Did you find this recap helpful? Please like or comment below this video to enter to win a free copy of our ebook, The Ultimate Real Estate Guide for Residential Real Estate Investments. You can also subscribe to our channel or go to our website to receive the latest in real estate news. Our website also affords you the opportunity to view our latest turnkey properties.